Now, we've got some things going on this weekend. Over the course of the weekend, we had Donald Trump coming out and tweeting, and now we've got an escalation. We're seeing that rhetoric coming out of the White House becoming more and more aggressive, and the actions are matching it too. We've got a ship that was seized that belongs to Iran. All right, and that's a result of the blockade on the blockade. That's a result of the US's blockade on Iran's blockade of the Strait of Hormuz. So that's what we are seeing. Let me just check this out. Let's just pull up our receipts, all right? We'll walk through this together, tab by tab, brick by brick. Latest Trump. Let's check that out. All right, so we've got that US seizes Iran cargo ship amidst peace talk standoff, as you can check there above. So Donald Trump said that the US seized an Iranian cargo ship that tried to bypass the blockade, and that's a move that escalates tensions and threatens to reignite the war with Iran. Now, the seizure, which Trump announced on Sunday, came after Iran refused to participate in a second round of peace talks, even as Trump reiterated his threat to attack Iran's infrastructure. I mean, bridges, uh, hospitals. No, not hospitals. I'm like, no, no, no. But infrastructure, buildings. I mean, power stations, bridges, all of the public infrastructure that the general public uses basically in Iran. We're also seeing that US negotiators are traveling to Pakistan again this week to resume negotiations aimed at ending the conflict. Now, we've got the action. Let's see what the reaction is. All right, let's see what the reaction is. Let's begin with oil because that's where everything begins and then begins to percolate downwards. And we see the downstream effect of this war that it is a headline-driven market. And if you can find out what the action is and what the reaction is going to be, then you can check the action reaction function to coordinate a beautiful setup. You feel me? Now, looking at oil straight out the gate, we can see that we gapped out coming into today's trading session, and that is because of the that tweet. All right, so the Truth Social rather. Again, who the hell uses Truth Social, guys? So fringe. Uh, but yeah, we're seeing that escalation rhetoric being priced into oil, and that beautifully bounces off this key support zone here at the bottom of the range. All right. We noticed that that held at the bottom of the range around 87 dollars a barrel. And now we're about, I mean, about, around about, let me just use my cursor there. We'll check that out. We don't need to speculate on these things like this. All right, run around $79. All right, so we bottomed out at $79 and then we proceeded to gap up in coming into today's Asian session or the Sydney session rather. We can see that effect right there on oil. We saw that gap out as traders price in more potential supply shocks when it comes to oil because of the Strait of Hormuz. The fact that this blockade is getting into a zone where we're seeing engagement and actual conflict and actual action signals to us that we're not in Kansas anymore. We're not just pricing in fear. We're pricing in the reality of this new escalation that we're seeing because of the US Navy blockade. So I presume that henceforth, if things do continue to be in escalation territory, we could move up to $96 a barrel. Right now, we're sitting at 87. That's a $10 gap up, guys. All right, from last week. That's a $10 difference, literally, from where we are right now. And I believe we still got another ways to go. So, first target would be $96. Again, you need to look at the action reaction function. All right, right now, escalation of the war rhetoric means a spike in oil. A spike in oil means a hawkish Fed because of the higher inflationary expectations that will then be priced in because of the higher prices in oil, and that results into a stronger dollar because of bond yields, and that is a sell gold scenario right now, and that's one thing I want to look at again. Let's see if that action reaction function is proving to be accurate. And let's check out the US dollar. So we said that if we see an escalation, we see a spike in the price of oil, and then that leads to a stronger dollar because of rate expectations and the safe haven flows. You feel me? So here we see, what's the date today? It is the 20th. So we're looking at the price action from there. All right. Weird that dollar has weakened. Let's check that out on a 1 hour time frame and see. During the course of the day, we are seeing some signs of cooling. All right, so we came out consolidating. So we basically rotated to the upside coming out from Friday. This is Monday, and we can clearly see that we are in the territory where we're trading slightly. Well, we traded, well, we pushed up just above that zone. So if we see a break to the upside here, above that 98 handle, I believe that we could be in a situation where the dollar could keep firming up all the way to 99 again, and that might be a first target before we see de-escalation again. That's the taco trade, ladies and gentlemen. That's the taco trade right there. Escalation, buy the dollar. De-escalation, sell the dollar, match it with the price action. That's all we do it right now. It's pretty scripted. I mean, at this point, Trump is operating in a pattern. Let me know what you guys think about that in the chat, but that's what I think. Let me know what you think in the chat. But we're seeing a pattern evolve here. Every Sunday is escalation day. And then around about Thursday, Friday, he pulls a taco. You get me? So that's where we're at right now. We're pricing in a stronger dollar in the face of that action reaction function, seeing oil spike, which will then favor the US dollar. Now let's see what that impact is having on gold. And according to the action reaction function, we should be seeing weaker gold or a cheaper price of gold. And Bob's your uncle. There we have it. Let's just check this out in a higher time frame. Or just scale it out properly, basically. No, what am I doing? All right, now let's narrow this down some more and fix it nicely. Remember, guys, the market won't react to these lines necessarily, all right? These trend lines are all subjective to a point. All right, objective, subjective. It's a balance of both. All right, you just gotta be fluid with it and map out the general zones of interest that we're looking at. Now, what we're seeing here, we've clearly broken that low. Oh my God. All right, let's have a look. So we gapped out through number one. All right, this was Friday's price action that pushed to the high, creating a new high above structure. All right, in relation to that high as well. So we're seeing three levels of rise. Boom, boom, and that's the third one. From there, we got that escalation tweet, gold gaps to the downside, and here's where we are right now. We're at the bottom of the range. All right. So that's what I'm looking at on gold. We bounced right around the $4,750 an ounce handle. And interesting that we're seeing that's where the structure came from. All right. So we've got sort of like a double bottom occurring in that at the bottom of the range, at our point of interest there when it comes to gold. But long story short, we've got scenario A and scenario B here. Again, according to the action reaction function, if we are seeing escalation in the war right now, you would expect to be buying gold in that kind of environment. But this is a headline driven market and this is an interest rate trade as well. All right. This is not just a geopolitics trade. Gold is not just moving right now based off geopolitics. We're also pricing in what is the Fed going to do if oil spikes out of control? All right. If oil touches 120 and stays above $100 a barrel, that has inflationary implications. And in the face of rising inflation, do you think that Fed is going to cut rates anytime soon? No bueno. No bueno. I don't think so. I don't think so. We're seeing an environment where we could be higher for longer. And speaking of which, that has a downward pressure on gold. We know gold is very rate sensitive. All right. So the longer this war goes on, the more oil stays above the $90 handle. All right. The longer the Strait of Hormuz is blocked and we still keep seeing supply disruptions being priced in, the more downward pressure is going to remain on gold because of those higher inflationary expectations, which then translate to higher interest rates for longer to try and restrain that inflationary impact. You feel me? So what we're seeing, yeah, we have broken below the structure over here. I do get that. I see that. That's a key point of interest. So this could be a new low in relation to that. Now I'm looking at the entire, body of work. I'm looking at this entire body of work as an independent structure in and of itself. All right. If I'm looking at that as an independent body of work, I'm seeing this as a new low. I'm seeing that as a potentially new low. Now let me do this again because we're at the higher high. And just hang on, get the right tool. We've got the higher high there, higher low, higher high. This is a new low, ladies and gentlemen. If we're going according to structure and price action, that's a new low, ladies and gentlemen. And then this can be construed as a new lower high. This is what I submit to you. That's what I submit to you. Do we get that? Do we get that, ladies and gentlemen? Let me know because according to the action reaction function, that's what we should be seeing. That's what we should be seeing. All right. In the absence of that, if that fails, then we are stuck with scenario number one. And scenario number one is that this level is still holding. All right. So we could find ourselves in a situation where we get something like, and that's the de-escalation narrative. All right. So if we see signs of de-escalation, a tweet from Donald Trump pulling a taco, we could potentially see something like this on gold. All right. Right now, gold is responding to the headlines. It is responding. It's not in the driving seat anymore. Gold is a passenger. It's not dictating its own destiny right now. Its destiny hangs in the balance because of the Strait of Hormuz. Right now, the price of oil right now is what's keeping gold either bid or under pressure. It's going to be responding to that until such time as the inflationary impacts that we're going to see from the oil spike start translating into a slowdown in growth, which then exacerbates a recession. If we get into recession territory and the market starts pricing in a recession, then gold will snap out of that reaction function and no longer be driven by the fluctuations in the price of oil, but then it'll rather be for a hedge against a potential recession, which will then be a straight buy. You feel me? So that's where we're at. If that happens, you'll know that you heard it here first. But that's my 2 cents, ladies and gentlemen. I think, yeah, what do you guys think? What do you guys think of the scenarios that we've broken down so far and how we've dissected this particular juncture where we are in the current narrative? Let me know in the chat. All right, let's look at the economic calendar. What are we expecting this week? Let's check out our calendar. All right, whilst we are in a headline-driven market, we can't ignore the economic calendar. It still also has a role to play in the price action that we're observing on these charts in this current environment right now. which is a crazy environment, if you ask me. Really, really crazy environment. Volatile, but in the absence of volatility, we're just going to be trading sideways markets, ladies and gentlemen. Does anybody want to trade a sideways market? Nothing, not. All right, so here's what's on the back burner. Here's what's on the docket this week. Here's what we have to contend with. All right, so tomorrow we've got retail sales. All right, very important right there. If we see signs, oh, look at that. Look at that slowdown from 3.7% to 2.4. All right. If we are seeing a slowdown in the US retail sales, we can make an inference that that's a direct possible correlation to the the rise of the price of goods. All right. As an inflationary consequence, you might have less demand for that product. All right, people might just hold back on buying certain luxury items or certain products that can go without just because there's been a spike in the price that's been driven by A, Donald Trump's tariffs, number two, as a consequence of this new war in Iran. All right. I don't know if it's too soon to start seeing the real-time inflationary impacts of the war, but if you're looking at CPI as an indicator, we are seeing a higher rate of inflation. So I think we can start surmising that the prices at a retail level are going up as a consequence to this Iran war. So retail sales is the first big thing that we've got to look at. If we get a slower number, that gets us ever so closer to the second narrative that I spoke about on gold, where we might start seeing slower growth. And if we start seeing slower growth, if we get, what's the definition of a recession? Is it 2 quarters, two back-to-back quarters of consecutive slower growth? Does that constitute a recession? I mean, we could just AI this right now. A technical recession, that is. Let's check out what Google has to say. Let's check that out. A recession is significant and widespread downturn in economic activity if it lasts for longer than a few months. Okay. Is it 2 quarters? That's what I want to know. Is it 2 quarters? Okay. 2 consecutive quarters. Guys, I really know my shit, eh? I really do. Jokes aside, putting up these receipts from the Mata, straight from the go. Ash, you can't buy this off the shelf at Checkers, guys. I keep saying, I know my shit. I'm so impressed with myself. Holy shit. Oh my word. Okay, we were checking out the economic calendar. Tuesday, Thursday, we've got initial jobless claims. We've got labor data on the back burner. And if we see cracks starting to form in the labor market, then that puts the Fed in a situation where, yes, we are seeing a war in Iran. We are seeing oil spiking. We have to keep rates higher for longer. Oh God. But if we start seeing the labor market cracking, then that makes things slightly more interesting for Jerome Powell and company because hmm, how high can you hold rates if we are seeing excessive job losses? Because at some point they're going to have to avert an unemployment recession. All right, we could see an economic recession take place, which is, slower GDP growth for 2 consecutive quarters. But we could also see an unemployment recession where we're seeing mass layoffs. And if you start seeing mass layoffs, then that's when gold kicks into that secondary scenario where people start hedging against a recession. Also knowing that in the event of a recession, the Fed is likely to drop rates anyway, which will then feed into gold being on the front foot. So there you have it. Two action reaction functions for free, ladies and gentlemen. All right. Told you what happens. What's driving gold right now in the advent of this war, and what's it going to take for that action reaction function to break or snap back to reality? Because we know that in only so much escalation is going to push gold on the back foot. at some point it'll reach a threshold where this escalation is too much. Things are getting out of control. We can't be involved in risk assets anymore. It's all going to flow back into gold. All right. So we need to prepare for that eventuality, in my opinion. But until such time as that happens, I believe downward pressure is still, I'm looking for the right word, a contributing factor when it comes to gold. All right. The moment we see escalation, we price in a spike in oil. If we price in a spike in oil, we price in higher for longer rates, higher for longer, stronger dollar, sell gold. That's the action reaction function right now. And that's what we're seeing as evidenced by that gap out in the morning. However, again, we are at the bottom of this range, so be careful until such time as we have a convincing break of structure. Then we know we're in a downtrend again. We need to see something like that. Then we really know we're cooking. All right. But until such time as we don't see that, we are still on the side of caution, I suppose. Right. So these are the two levels that we're looking at. Very, very important. Very, very, very important in as far as structure is concerned, because we could also see something like that. Oh, we could still see something like that as well. All right. So monitor the headlines, guys. Keep Bloomberg on in the background. Keep abreast of the headlines because you need to keep your head in a swivel in this kind of environment. Honestly speaking, I think you got to keep your head in a swivel. All right. Any questions for me, guys? I will take them in the chat. I actually do read the chat, guys. So if you're watching this retrospectively on YouTube, I actually do read the chat, guys. Please leave me some comments. Let's help grow the channel. It is a relatively small channel. However, I think that I'm providing quality. I can't even lie. Nobody goes this far in the conversation in South Africa. Nobody takes it this far in the conversation. They'll just do technical analysis until they're blue in the face. But over here, my good sir, we dissect it, we subdivide it. You feel me? So I'll leave you with that. All right. You guys want to follow me on Instagram? My handle is Mr. _ Waisi, sir. If you want to follow Just Markets, it's Just Markets Official.